Most retail traders have a common problem. They enter the market too late. But why does this happen? It's not necessarily because they are wrong about the market direction. It's because they chase the price. When they see a big green candle, they panic and jump in, thinking they are missing the move. This is the definition of FOMO, fear of missing out. Professional traders do the exact opposite. They don't chase the market. They let the market come to them. Instead of buying at the top of a breakout, they stay patient and wait for pullbacks. They understand that a breakout is just the beginning of a story. To enter a high probability trade, you need a pullback, structure, and most importantly, confirmation. In this masterclass, I'm going to show you exactly how to trade pullbacks with structure, patience, and precision. We will cover the two most reliable pullback strategies in existence, the break and retest and the trendline bounce. I will also explain the liquidity sweep logic that the big institutions use to trap retail traders. Ready to stop chasing and start trading like a pro? Let's begin. Strategy has honed, the break and retest logic. Let's start with the first pullback strategy, the break and retest. This is a simple but incredibly powerful way to trade with clarity instead of emotion. Many traders see a price break, a support or resistance level, and they buy or sell immediately. This is a mistake because that breakout could be a trap designed to grab liquidity before reversing. By waiting for a retest, you are staying patient and allowing the price to return to that broken level to confirm it. This confirmation step is your filter. It helps you avoid those deadly false breakouts and gives you a much more structured and confident entry point. Think of it as the market giving you a second chance to enter at a better price. The psychology behind the scenes. Why does the price pull back? When price breaks above a major resistance, it's a sign that buyers are strong. However, markets never move in a straight line. As price rises, early buyers who entered near the bottom start taking profits. This profit-taking creates temporary selling pressure, causing the price to dip. Retailers see this dip and think the trend is over, but smart money sees this as an opportunity. They wait for the price to hit the previous resistance, which has now flipped into support. If that level holds and price shows rejection, it confirms that the bulls are back in control. This is the change of character we look for. Case study: XAU, USD, and the range breakout. Let's walk through the process step by step with a real example. Look at this XAU USD chart. First, we identify a clear key level where the price has reacted multiple times in the past. Strong levels matter. Weak levels tend to fail. Here, we have a clear support zone. Notice how the price eventually breaks below this level with a strong bearish candle. When the breakout happens, you do nothing. You don't chase the move. You wait. As the price pulls back toward the broken support, you observe how it behaves. Your goal is simple. Confirm that the previous support is now acting as new resistance. If price reaches the level and rejects it with clear price action like a bearish pin bar or a rejection wick, that is your confirmation. In a range-bound market, this is even more critical. In a range, price bounces back and forth between support and resistance with no clear trend. This is where most traders lose money by getting caught in liquidity sweeps. When price finally breaks out of the range, remember, the breakout is not the entry, the retest is. Wait for the market to respect the new boundary before putting your capital at risk. Strategy #2, the Trendline Bounce Masterclass. Now, let's move on to the second pullback strategy, the Trendline Bounce. A trendline is a simple but effective tool that helps you visualize the market direction. It is drawn by connecting swing highs or swing lows. Its purpose is not to predict where the price will go, but to provide a structural guide for where pullbacks are likely to end. To draw a valid trendline, you must follow these professional rules. Rule Hasson: a trendline needs confirmation. You need at least 2 clear touch points to draw the line. The more times the price reacts to the line, the more relevant and strong it becomes. But remember, more touches don't guarantee it will hold forever. A trendline is a tool, not a promise. Rule #2: markets are not perfect. Trends are rarely clean or smooth. Price might briefly break a trend line, then close back inside, or it might spike through it to grab liquidity. This doesn't mean the trend line is useless. It means you must read the price behavior around the zone, not just the line itself. Rule #3. Think in zones, not exact lines. Price will often react slightly before or slightly after touching your line. Focus on the reaction zone. Rule #4. Never force a trend line. If you have to move your line around or ignore major price swings just to make it fit, it doesn't belong on your chart. A forced trend line gives you false confidence and leads to bad trades. Draw it logically based on natural price structure, or don't draw it at all. Advanced Confluence. Gold analysis. Let's apply the trendline bounce strategy to a real-world scenario on XAU/USD. Gold. Using a 5-minute chart, the market is clearly trending higher, making higher highs and higher lows. We connect the swing lows to draw our trend line. We are waiting for a pullback. When gold pulls back to our line, we don't just buy. We look for multi-timeframe alignment. We zoom out to the 1-hour chart to see the bigger picture. On the 1-hour chart, we notice a liquidity sweep. Price briefly broke below a support area, then closed back above it. This tells us that higher timeframe buyers are active. This is our confluence. When the lower timeframe, min, and higher timeframe, 1H, align, you have a powerhouse setup. The execution. On the 5-minute chart, as price hits the trend line, we see a bullish engulfing candle. This is our entry signal. We place our stop loss slightly below the trend line or the recent swing low to avoid being stopped out by minor noise. Our take profit is set at the next key resistance level, aiming for a minimum 2-to-1 reward to risk ratio. As you can see, gold respected the trend line and the momentum resumed perfectly. Conclusion: the path to precision. Trading pullbacks is about mastery of patience. You are letting the impatient traders get trapped while you wait for the market to prove its next move to you. Whether it's a break and retest or a trendline bounce, the secret is the same. Wait for the retest, wait for the confirmation candle, and always check your higher timeframes. These two strategies are powerful additions to any trading plan. But remember, they work best when structure, price action, and context are all aligned. You aren't guessing, you are reacting to clear market behavior. Keep practicing these setups on your charts until they become second nature. If you found this video helpful and you want to dive deeper into professional trading techniques, don't forget to like, subscribe, and hit the notification bell. I read every comment, so let me know what you want to see next. Thank you for watching, stay disciplined, and I will see you in the next lesson. If your Elliott wave count keeps changing every time price moves against you, you're not reading the market, you're forcing the market to fit your bias. In this video, I'll show you how to identify clearer wave structures and avoid the mistakes that trap most traders. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. In the general picture, it is one of the principles, or what many people call a theory. This principle believes that the movement of the price in the stock market will have the shape of a swing. Swing, right? The shape will be like this. If you look at this picture, you will see the two properties of the swing. The first one is that it goes up and down. It's going up and down for a while, and it's going to repeat. It's not going up and down and then it's over. It's going up and down over and over again. It's going up and down over and over again. It's mainly caused by thoughts. It's caused by emotions. And it's caused by the actions of a lot of people. A lot of people in this place are investors. It means it's going to be big or small. When they make a trade or invest, it will reflect in the price graph. For example, in this picture, if you look at it, it will rise, starting from the left-hand side. At first, the price goes up, then it goes down, and then it goes up again. This time, it is stronger than the previous time. There is a short drop, and then it goes up at the end. These events are very reflective of the actions of people. For example, in the first period of the left hand, many people will be careful because the price should have fallen first. Therefore, people will gradually buy in hesitation, not sure. After that, when the price starts to go down, it is a shortcut. People will be afraid, both afraid and not sure. After a while, the price went up again. At this point, there is excitement and confidence. Everyone will come to buy together. After buying, the price goes up. It becomes a good price. People who bought from the first round will start to worry. Excitement is gone. Start to sell for profit. The price will go back. But because last time it was very exciting, everyone goes shopping. People who get off the car or can't get in time will get sick, and the mountain will try to buy more, hoping that the price will rise high. Finally, the price doesn't go back. When it comes back, there will be a sale and the price will fall back. This idea makes investors think about the principle. This person's name is Mr. Elliott. He came up with the principle called wave principle in 1930, and he got a promotion from an important foundation of Dow theory. You can see Dow theory in the channel. There are 2 episodes, but I would like to summarize briefly for you to listen to this. Dow theory, one of the points, he said that the trend, there will be 3 types of milk: the main milk, the second milk, and the third milk. For example, if you look at the main trend first, you will see that it is a rising market. The rising market will make the higher high or the higher high, and it will make the higher low as well. Next is the second trend. Dow Jerry said that the trend will move in the direction of the main trend. Therefore, the main trend is an upward market. The long trend is a downward market, but it is a short downward. It occurs when the price rises or falls. Finally, the trend is the trend. The trend is the movement of the price hidden in the main trend and the long trend. For example, on the left-hand side, the curve is the main curve, but there is a slope curve. It's in this curve. Another point is in the middle. It's a vertical curve. It's a short downward market, but there is a slope curve. It's in the vertical curve again. Mr. Elliott concluded that it was one of the principles. Basically, I would like to show you an example of an upward-leaning market, but this method can also be used with a downward-leaning market. Mr. Elliott said that the movement will be a set. One set will consist of an upward leaning, which is in this picture. The upward leaning is called a motive wave. Motive wave will consist of 5 legs or 5 shifts. The way to count is to count from the far left, the first point of the shift. The first shift is the shift that goes up. Next, the second shift will rest. The third shift will go up again. It's a long shift. The fourth shift will be a shift again. And the last shift, the fifth shift, will go up again. After that, the Elliott wave says that when the movement reaches 5 legs, there will be a break. The big break is called the corrective wave or the adjustment. We will use the Thai word for adjustment movement. In this adjustment movement, the Elliott wave says that it will have 3 legs or 3 small movements. It will be named ABC. A is the extension in the lower leg. After that, there will be a rest in the lower leg. Finally, there will be a descent into the lower leg. Therefore, if we count all the movements, there will be 8 legs or 8 movements. We call this system 8 waves, and we will give a symbol of 5 to 3. 5 is up, yellow, and 3 is the vertical axis. I have an example for you. You can pause the video and try to draw the movement. The upper leg has 5 movements and the lower leg has 3 movements. If you have tried drawing, I will take you to see the answer. The answer starts with the upper leg, which has 5 movements. We call it the motive wave. Let's start from the left-hand side. 1 goes up, 2 goes down, 3 goes up again, 4 goes down, and 5 goes up at the end. After that, we can draw the corrective wave. The corrective wave will have 1. When it goes down, it's A. When it goes down, it's B. And when it goes down, it's C. That's it. 8 moves together as one group of the Elliott wave. Next, you may have a question that when we draw it all, what will happen next? Will it go up or will it go down? Or how will it be? I take you to see the example. This picture is the 8 or one group of the Elliott wave. At this point, there are 2 possibilities. First, there will be another wave that arises from the top. This type of wave is called the wave that is rising, or the price is still rising. Another type, when it ends at point C, it will go down and turn into this shape instead. It's another wave that is turning. In this way, he sees that the rising market has ended and then turned into a downward market. Therefore, in short, Mr. Elliott thinks that these 8 waves will keep repeating. it depends on whether it will repeat upward or downward. This time, the specialty of the Elliott wave is that it has another quality called fractal or called structure, which is the structure. The same structure will repeat over and over again in many time frames. For example, this figure. This figure is a set of Elliott waves. Suppose it is in a large time frame. It is in the higher degree or the degree with a high cost. And at the same time, it will have a set of waves in the lower time frame. This lower time frame is called lower degree. Therefore, the word degree is the level indicator of the movement. The movement in each degree has a different pattern, which has a clear gain. For example, on the left-hand side, move 1 and move 2, it's a move up and down. If you zoom in, you may see a move like this. This move is a lower degree move, lower time frame. It's in move 1 and move 2 again. And if you look closely at move 3 and move 4, it's the same pattern. There's a move up and a move down. Therefore, there may be a tendency to hide inside again. Finally, when the price starts to go back or adjust, it can have a tendency to go back to the head and hide. This method is called fractal. We will see these images hidden in many time frames. Start with the big time frame first. Time frame month, time frame week, and you can try to change the time frame. It can be 1 day, it can be 4 hours. You should see the small moves hidden in the big moves again. In other EP of this series, we will roll back and forth between these sets of moves. Left hand is motive wave with 5 legs. Right hand is corrective wave with 3 legs. If I divide it into 2 parts, the motive wave will be easier than the corrective wave on the right side. The corrective wave is more difficult, and I would like to emphasize that it is much more difficult than the left hand. For today, I would like to start with the motive wave first. It has a clear structure and is easy to see. The motive wave is mainly divided into 2 subgroups. The first group is called impulse wave. The other group is called diagonal wave. In impulse wave, the shape is simple. There is a clear structure. Look at the graph and you can tell. The shape is similar to the example that I showed you. The second type, diagonal wave, is complicated from impulse wave. If you look closely at the structure, there will be a part that is similar to the impulse wave and another part that will be different. For example, on the left-hand side of the diagonal wave, there will be 2, 3, 4, 5 movements similar to the impulse wave. But the difference is that the first movement of the impulse wave is easy to see. The price goes up continuously, but the diagonal wave is more complicated. The price will bounce back and forth in the first movement. Another example is the right hand. The right hand moves like the impulse wave, which is 1, 2, 3, 4. But there will be a 5th movement that will bounce back and forth, different from the impulse wave. For this clip and the next clip, we will focus on the impulse wave. It is a movement with a simple structure that can be clearly seen. An impulse wave is a 5-wave structure that moves in the direction of the main trend and represents the strongest phase of a market move. Within this structure, waves 1, 3, and 5 are known as impulse waves because they push the market forward, while waves 2 and 4 are corrective waves that temporarily move against the trend before the next impulse begins. Although corrective waves create temporary pullbacks, they do not change the overall direction of the trend. To identify a valid impulse wave, you only need to remember 3 essential rules. First, wave 2 must never retrace beyond the starting point of wave 1. It can pull back significantly, but if it moves below the origin of wave 1, the wave count becomes invalid. Second, wave 3 must never be the shortest of the 3 impulse waves. While it is often the longest and strongest wave, the rule simply states that it cannot be shorter than both waves 1 and 5. Finally, wave 4 must not overlap the price territory of wave 1. If it does, the structure is no longer considered a valid impulse wave. These 3 rules are the foundation of Elliott wave theory and are the first things professional traders check before labeling any wave count. Once you understand and apply them consistently, identifying high-quality Elliott wave setups becomes much easier. In the next section, we'll go through several real chart examples so you can practice counting the waves and verifying whether each structure follows these essential rules. Let's take a look. The first wave is the impulse wave, the first wave. Pause the video. After that, we will try to open the answer. The wave that I got will be like this. The beginning is the bottom point. After that, it will be the first wave. Go down 2, go up a long way. It's number 3. Go down to number 4, and then go up to the last round. It's the 5th move. Next, we will try to check whether it passes all 3 goals or not. We will check from the first step. Wave 2 must not be lower than wave 1. Actually, looking at it with my eyes, I know that wave 2 is still not the best. But if we try to measure it, we will see it clearly that the second wave is about 80% of the first wave. Therefore, this is considered to be a gain. Next, the second rule says that the third wave will not be as short as the impulse wave. The impulse wave consists of waves 1, 3, and 5. Let's review it again. Therefore, from the graph, we can see that the third wave is not short at all, longer than my friend. Therefore, it is considered to pass the gain. The last gain, he said that the fourth wave will not enter the zone of the first wave. We tried to draw the zone of the first wave, and we can see immediately that the fourth wave is still far away. It's still not close to the first wave. Therefore, all 3 gains are considered to pass. We got one beautiful impulse wave. The second example is similar. It's a rising market and then it goes back down. You can pause the video as before and then come and see the answer. The answer? We will start from the lowest point on the left-hand side, which is this point, and then we will measure the rise up. 1 rise, 2 yaw, 3 rise long, 4 new yaw, and this time the 5th rise will be long enough. We have to check 3 important things first. The second wave must not exceed the first wave. Therefore, if we measure the range, it will be similar to the example just now. At the second wave, it is about 80% through the gain. Next, as before, the third wave must not be the shortest in the 1-3-5 ladder. When we look at the picture, we see the shortest one immediately. That's the first wave. So this button passes the gain as well. Lastly, the fourth wave will not enter the first wave zone. This example is very annoying. If we draw the zone, we will see that the fourth wave almost enters the first wave, so it's still passing the gain. Finally, we get an impulse wave that has a good structure. It's easy to see another one. The last example, the third example. This example is a bit difficult. Some of you will be able to draw it in one way, and the other group of friends will be able to draw it in another way. You can pause the video as before, and let's look at the answer. The first answer is like this. The first point, we will start from here. After that, it will go up 1, down 2, up 3 long, down 4, and up 5. Like this. Check first if it is correct. If it is correct, we will set it to impulse wave. As before, the first step, wave 2, must not go down to wave 1. Looking at the picture, it doesn't go down. Therefore, it is considered to pass the gain. Press the second step. Wave 3 must not be the shortest. Of course, wave 3 is the longest. Therefore, all 3 items have passed the gain. We set it to be a good impulse wave. This time, friends may say that I did not draw like this. I drew another one that will come out like this. Like this? Do you think it's wrong? No, it's not wrong. Let's check all 3 criteria. After checking, we will find that it also passes the criteria. Therefore, now there is a question. Which one is the right one? Is it like this, or is it the first one that I drew for you to see? This question is a difficult question because each investor, they can't count back either. Some people used to say that 20 people can count back 20 ways. This point made many friends stop being interested in Iliad Wave because they see that it has an uncertain system. It depends on the mind and the mood of the person counting. Today I will take you to see the main reasons why investors. The first thing I would like to say is that the starting point of counting is different. Therefore, the result is not the same. For example, the starting point has 2 points. If we look at the yellow point, we will be able to move in one way. But if we start counting at the blue point, we will be able to move in another way. These 2 movements are problems that may be fixed. The main way to fix it is to look at the movement before the face. Looking at the movement before the face may be the previous movement. Therefore, we will find the starting point of this movement easier and more precise. The second problem of not counting the movements is to determine the high point and the low point that are not the same. This problem is a very global problem. If you trade with many currencies, sometimes you will count high and low, not the same. For example, this picture. Let's just take the high point first. I let you try to find the high point. How many points are there in this graph? Some people say that there are only 2 points, but many investors look back and see that there are other points. Are these points high? And is this point high at the end? Therefore, if each person looks high and low alike, we will not draw a line. There will be no fluctuation in that area when we calculate the fluctuation of the Elliott wave. Here's how to fix it. Look at where it is a high point. Suppose we choose this point to be a high point or not. The most systematic way to do it is that we have to choose that point first that we are curious about. After that, we will count the bars left and right. It depends on the number of bars. For me, I used 7 bars in the past. Currently, I may only adjust 5 bars. After we get 5 bars, we will see that the left and the right poles must not have any poles higher than this pole. That's why we set this pole as a high point. Let me zoom in. The point we are interested in is this point. We will count the left and the right poles as 5 poles. The right pole is like this, 1 to 5. The left pole is 1 to 5. Then we will see which pole we have. Is it higher than the pole that the child pointed at? When we look at it, there is no point or any point higher than this pole. Therefore, this pole is set to be a high point. Identifying a swing low follows the same principle as identifying a swing high. First, choose a candle and decide how many candles you want to compare on each side. For example, 5. If no candle within those 5 bars to the left or right has a lower low, that candle qualifies as a swing low. However, if you increase the setting to 10 bars and find a lower low within that wider range, the original point is no longer considered a valid swing low. This is why different traders often identify different swing points. To avoid inconsistency and personal bias, it's important to use the same look-back setting throughout your Elliott wave analysis. Therefore, the way to solve it, we will have to stick to a system that we set from the beginning to reduce the bias in counting. Currently, I use 5 bars, but in the past, I used 7 bars. The third reason why counting waves is not the same is because of the different time frames. For example, on the left-hand side, it is a time frame week. If you are in this time frame and you try to count the movements, you may be able to count like this. The first movement has a starting point on the left-hand side. The screen is removed and comes up to the last point. Count is 1. After that, it came down to 2. Come up again, friends may be able to count 1 point, which is the third point. As for the 4th and 5th moves, it will not be shown in the week time frame. But if you zoom in at 1-day time frame and try to count again, we start counting at a point similar to the previous point. Therefore, we will get the first point as this point. Counted, the move will come out like this. All 5 of them are complete. The first one comes up. There's a long extension. It's number 2. It's going up again. It's hard. It's number 3. The last extension is number 4. And then it goes up, but it can't go up. The momentum is gone. It's the 5th shift. Can you see that the different time frames will make the countdown different? If we look at the left hand, this point is still wave 3. But if we look at the right hand side, we can count on wave 5. Most investors will start with a big time frame, such as time frame week or time frame month. We will try to find the movement in that time frame. After that, we will use Fractal's principle to zoom in to see the movement that is hidden inside again. And the last reason for not being able to count the movement is, it's because of this reason. Elliott wave has complexity in itself, or to put it another way, it's not easy. It has difficulty and chaos that I myself almost give up using this method. Therefore, if we want to increase the efficiency of counting to be more precise, we need to find a tool to help. This tool will help our counting. It's as much of a system as it can be. And what comes from the word system, we will have to use the number to control instead of using the mind. That thing is called Fibonacci ratio. In the next clip, I will take you back to see the motive wave again. But we will use Fibonacci to determine how to calculate to be more efficient and more accurate. And see you in the next clip. Don't forget to follow us. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. Gold, XAU USD. To some, it's the ultimate money printing machine. But to 90% of traders out there, it's a ruthless nightmare, ready to crush and blow any account in a single night. Have you ever experienced buying just to see it crash? Or selling only for it to spike, hit your stop loss, and then go your way? That's gold's specialty: liquidity sweeps and psychological traps. Welcome back to the robergoldtrader channel. If you are still struggling in the endless loop of stop losses and blown accounts with XAU USD, congratulations, you found the right video. Today, I won't talk about pure theory. I will dissect the entire brain, logic, and mindset behind my top 3 go-to scenarios that I confidently use to hunt gold daily. These are live trades with real money and real results. Grab a pen and paper, because what you're about to see might completely change how you view the gold chart forever. Scenario 1. The bear trap and the dragon's bounce. 15 time frame setup. Look at the context of this chart. Previously, the seller's bears created a terrifying dumping force. Red candles plummeted, breaking through minor supports. What is the crowd thinking right now? Gold is broken. Let's chase the sell. And when the crowd jumps in to short at the bottom, they officially fall into the shark's trap. Price stalls, and suddenly buyers counterattack with a series of vertical green candles, totally breaking the previous bearish structure, boss. Why did the buyers suddenly appear here? Never look at just one time frame. My secret is to switch to the 4-hour H4 time frame. On H4, we clearly see that the price area where the crowd was chasing sells is actually a massive demand zone created by buyers earlier. The sharks were just waiting for retail to sell so they could accumulate at a discount. Knowing the macro trend has turned bullish, should we FOMO buy and chase the green wave on M15? Absolutely not. The difference between pros and amateurs. Pros wait for pullbacks. Gold always has a habit of coming back to pick up passengers. I will drag the Fibonacci retracement tool from the base of the impulse wave to the top. I pay special attention to the golden ratio zone, 0.5 and 0.618. As expected, the price corrects slightly right into the Fibo 0.618 level. Coincidentally, this area perfectly confluences with an old broken peak. Resistance turns support. This is the deadly confluence point. But wait, the final factor that made me extremely confident to pull the trigger? Timing. This touch happened at right during the transition between Asian and European sessions. London Open. The London session opens. Big money flows into the market. Price rejects going lower, creating a beautiful pin bar. I enter a long instantly. Stop loss safely below the structure creating low. Take profit, aim straight at the liquidity peak above. Look at the result. Gold bounced like a long compressed spring. By evening, when the US New York session kicked in, it pushed the price straight through my TP with just one candle. A flawless win by reading the exhaustion of sellers. That was a reversal scenario. What if the market is trending beautifully? Let's move to scenario 2, the King's Price Squeeze, Volatility Squeeze. Here, on the M15 XAU USD chart, we have a textbook strong uptrend structure. Higher highs, higher lows. The steep upward slope shows buyers are completely dominating the game. However, no market goes up forever. After a strong push, the market enters a resting state. Price moves slower, candle ranges tighten, and trading volume dries up. Price is stuck in a compression triangle. Symmetrical, pennant. Many people hate this sideways phase. But for me, this is a gold mine. Compression is always the prerequisite for expansion. The longer the squeeze, the more terrifying the explosion. The problem is how to avoid fakeouts. The crowd often gets hit by gold's wick sweeps before it actually flies. My secret lies in confirmation. I never buy right when the price pokes through the triangle's edge. I wait for a solid body candle, Marubozu, closing decisively outside the pattern, accompanied by a sudden spike in volume. This confirms smart money has injected funds to push the price. Boom! A beautiful breakout candle. Buy order activated immediately. I don't set my stop loss too close to avoid market noise. I set it safely just below the triangle's edge or the last squeeze low. What is the absolute advantage of a gold breakout scenario? It's speed. Once gold decides its direction after accumulation, it doesn't mess around. It'll run straight, green candle after green candle, right to your target. A seemingly simple scenario, but demands iron discipline. You must endure the boredom when it moves sideways, and be sharp and decisive the moment the confirmation signal appears. Never predict the direction. Let the market speak for itself. Finally, we come to scenario number 3, the gravitational crash. In financial markets, there's an adage: bulls go up the stairs, but bears jump out the window. Elevator? Shorting gold often brings incredibly fast profits because it's driven by fear psychology. Fear always spreads faster than greed. Let's look at this H1 timeframe picture. Gold was rising strongly before, but now the structure is broken. Sellers start rushing in to smash the price down, creating lower highs. Supply pressure continuously weighs on the market. However, buyers are still trying to defend to the death at a horizontal support below, creating equal lows. The combination of lower highs and equal lows creates the deadly descending triangle pattern. This is a life or death battle. Bulls try to defend, but bears get increasingly aggressive, pushing them against the wall. The bull's endurance is gradually exhausting. Where is my trigger point? I zoom in on the sharp corner of the triangle. I spot a micro consolidation right on the edge of the support. As soon as a massive red H1 candle with high volume pierces this small accumulation, shattering the horizontal support, I immediately enter a short order. The buyer's defensive structure has crumbled. All buyers' stop losses below this bottom will be triggered liquidity cascade. When the buyer's stop losses, which act as sell market orders, combine with the aggressive selling from sharks, it creates an avalanche effect. Gold price free falls, violently plunging straight into my take profit. Too fast, too furious. Ladies and gentlemen, technical knowledge only accounts for a very small part. Throughout the 3 recent scenarios, what is the most important thing? It's confidence and patience. There have been countless times I opened the gold chart and saw a setup that looked okay. But my gut and experience told me something was off. Maybe the previous wave wicks were too long. Maybe FIBO didn't align, or major news was coming. And my ultimate golden rule for survival is, when in doubt, absolutely do not pull the trigger. If you hesitate, your win rate has already halved in your mind. Better to regret missing a winning trade than to embrace the agony and lose money forcing a bad trade. This multi-billion-dollar gold market doesn't lack opportunities. It runs 24/5. Don't force yourself to trade every hour. Be patient like a sniper. Journal your trades. Backtest these 3 scenarios hundreds of times until they are deeply ingrained in your subconscious. When you see a setup that converges all factors, structure, FIBO, liquidity, volume, and timing, at that moment, Enter confidently with no regrets. Quality always beats quantity. I wish you success in forging iron discipline and turning XAU/USD into your own diamond mine. If you found value in this video, don't hesitate to like, share, and subscribe to the Rober channel to not miss the next top-tier live trading lessons. Welcome back, traders. Rober is here. Today I have a short trade technique for you. This technique is called ORB, or Opening Range Breakout. Let's meet this technique. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. ORB is a scalping trade technique. Mainly, we will focus when the market opens. During the opening of the market, there will be a very high volatility. And most of us will use this technique with the stock market at the time of New York. The stock market we use will be New York Stock Exchange, or NASDAQ. During the opening of the New York market, it will be the closing of the London market. Therefore, it will be a period of time when the market is stagnant and very volatile. When the price is very volatile, there is a chance to make a lot of profit. The graph will be like this. Suppose I have a line. This line divides yesterday's time and today's time. When the market opens, we will determine the period or range. This range is called the opening range. After we finish the period, we will consider that during this period, we will do the job like a channel. There is a bottom line and a bottom line at the top. The price has the opportunity to bounce back and forth around this channel. And the point that we are interested in entering the trade is the point where it breaks out or breaks through the bottom line. Next, you may have a question about the opening range. How much time do we use to schedule? Most investors will use the period at which the market is tense for only the first 15 minutes of each day. If it is a New York market, it will be from 9:3 a.m. to 9:45 a.m. There are many reasons why the market is tense at this time. It may be an order that has been held since the market closed, or in the past night, it has been reported by the economy. And another factor that cannot be overlooked is that the big price fluctuates in the first period of the day. I have an example for you to see. It is the opening of the market for 4 days. These 4 days will use the graph for 5 minutes. Therefore, when the market opens for the first 15 minutes, it will be equal to 3 bars. On the left-hand side, you will see that when the market opens, the first 3 bars have a lot of volatility. The price has dropped sharply. We can mark this range as it is. The second day is still the same. When it opens, there is a gap up. When it opens, the price goes down within 15 minutes. We also got a range. On the third day, we will go back. When the market opens, it will open low. But when it opens, the price will create a range in the positive direction. We also got another range. Finally, the market opens low and rises as well. We also got a range. These 4 examples, you will see that the price is very volatile in the first 15 minutes. After that, the price may bounce or break out. The important key of this technique is that we will not trade in the first 15 minutes. We are not sure what will happen in that period. The price may fluctuate, or it may be a fight between the financial institutions. Therefore, we will wait for the price to start steady and then find the time to enter the trade. Our setup will be divided into 3 steps. It may look a bit too much, but when trading, friends can do it quickly and find the time to enter the trade easily. The first step, we will look at the market trend in the overall picture first. This step we will use at the time frame of 15 minutes. We will see that the market is up or down. After that, we will look at the trend in the past. Most of us will look back 2 to 3 days. And finally, we will determine the range of the first bar or when it passes 15 minutes after the market opens. The method is according to this graph. The time frame is 15 minutes. Let's divide the day. For example, I have the day before and yesterday compared to today for you to see. Now it's 9:3 p.m. The market is just starting to open. We will look at the trend of the day before and look at the important trend. For example, on the day before, the price has risen, then the long sideways. Therefore, it is an important resistance. After a while, the price went up and went down again, but did not go further. Therefore, this area is also a resistance. In general, the old resistance has now turned into a resistance. We can mark the position. In addition, if you look at the high position of the previous day, the price rises and bounces down, there is a small trend. After a while, when the new day begins, this trend has become a trend. The price rises and rises. The moment it rises, it comes back to test at the same trend, which is now turned into a trend. We can draw another line. At the end of yesterday, half a day in the morning, the price was sideways. The price will go up or not. After half a day in the afternoon, the price went up and then went back up. When it went up, it was a fixed trend. Therefore, the original trend has now become a fixed trend. We got the key level out. After that, we will determine the range of the first bar. After 15 minutes, now it's 9:03 a.m. The market has just opened. Wait for 15 minutes. The price has risen dramatically. It has turned into 9:45 a.m. Therefore, we can determine the range at the first stop. This range will be measured from the high point to the low point. We call it opening range. And the upper side of the range and the lower side, we will call opening range high and opening range low. Use the symbol ORH and ORL. The next step, the second step, we will check that the range we just drew, is it big enough? If the size is big enough, it means that the market is very competitive. The big line may leave a mark so that we can trade with it. We will go back to the one-day time frame. We will check the range of the stock in the first step to see how big it is compared to yesterday's ATR. If you remember, ATR tells the market performance. We have to look at how much today's trading performance is compared to yesterday. And to get through today's gain, there must be more than 1.4% of ATR gain yesterday. Let's take a look at the example to make it easier to see. This example is the range that we have specified in the first step. We will check whether the range of this tank is large enough. If it is large enough, it may be the price of the large line itself. In this example, the range of the first tank is about $5. After that, we will go back to the ATR of yesterday. I will show you the graph on the left. This graph is a one-day time frame. Therefore, each column is the price movement yesterday and the day before. At the bottom is the ATR that measures the price fluctuation. We will focus on yesterday's column. This column, we will look at the ATR. We will read its value, which when we read it, we got a price of about $6. At this point, we almost don't have to check anymore. The first range of today is $5. Very profitable, similar to the price movement yesterday. Therefore, today's opening range will actually pass the gain. But for you to see the picture, let me calculate a little bit. Yesterday's ATR was blue, about $6. 25% of ATR, or 1 in 4, is about $1.5. Our gain said that today's opening range will be wider than 25% of ATR. After comparing, we will find that $5 is more than $1.5. Therefore, today's yellow has more value than yesterday's blue. It is considered that through gain, we can find the time to enter the trade in the third step. The third step is to enter the entry and exit the trade. The time frame will change to 5 minutes, and we will try to enter the trade within the first 2 hours of the day. The market opened at 9:3 the first 15 minutes. After that, we will wait until 11:3 to enter the trade. For the original opening range breakout, they will trade only breakout. But I have divided this technique into 3 types. 3 types will have a normal breakout, a breakout, and pullback. We also have a reverse or return price. For this clip, we will focus on the breakout only. For the next clip, the second one will be a pullback trade and a reverse trade. Let's take a look at the graph. Entry and exit, the first one or the breakout. The first step, we have a blue bar, right? This bar is the bar that opens at 9.3 to 9.45. We will get a range. After that, we will change the time frame to 5 minutes. After changing, bar 1 will become bar 3. 5 minutes per bar, 3 bars is 15 minutes. and we will wait for the time. Wait for the price to bounce back and forth until it breaks through the range. The moment it breaks through, we will find the moment to enter the trade. The second pattern, the pullback technique, the idea is the same. We got the range first, change the time frame. After that, we wait for the price to break out. When the price breaks out at this point, we will not enter the trade. We will wait for the price to pull back and test the resistance. The old resistance is now a resistance. We can find the time to enter the trade. The last pattern is a reverse trade or a return trade. At first, when the market opened, it was a big green bar. The price really broke out. But it's a fake breakout. The price goes up and down. Therefore, we can find the opening time after the fall breakout. Today, I have 4 examples for you to see. These 4 examples will be a model of a single breakout trade. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. Let's meet the first example. First, I will mark the day before to compare to see 3 days in a row. There was a day before, yesterday and today when the market was opening. If you look at the trend, we will see that the past 2 to 3 days, there was a trend of the market to rise. After that, when the market opened for 15 minutes, we got a red dot, 1 dot. This dot, we will determine the range from the top to the bottom. After we have determined, we will check the 25% ATR gain, which, all 4 examples, I have checked the gain, and it passed the gain. Therefore, I will not show the time when we check the gain. After checking, we will change the time frame to 5 minutes. From 1 bar, it will turn into 3 bars like this. Once we get the range, we will drag the edge to the length of 11.3. During this 2 hours, we will find the time to enter the breakout trade. Because this example is an upward market, we will trade only on the buy side. Wait for the breakout to occur in the next week, which is enough to wait for the price to come out like this. Below, you will see that the price has gone down, but we don't count. We don't set it to be a breakout. We will count when the price closes outside the range. As for the upper side, it is not set to be a breakout either, because the price has not yet closed the upper range. We have to wait. Wait a little longer, the price will break out. When it breaks out, it closes the upper range, which is considered through the gain. This bar I call the first bar. We will not buy immediately. We will wait for another bar to turn green as well. When there are 2 green bars, we can find the time to buy. The reason why there must be 2 bars is because there are many times that the first bar breaks out, but when it is the second bar, it goes back down immediately. If we buy at the first bar, there is a chance to lose money when the price goes down in the second bar. But in this example, there are 2 green bars attached to each other. We can place a buy. Next, we will place a stop loss. Our stop loss will be at the top range or opening range high. After we get a stop loss, we will place a TP with at least 2 to 1 RR. TP will be like this, which is quite far. Once we enter the order, we just wait for the price to go up until it hits TP. We sell it out and get 1 profit. The next example is still a market. I want to divide the day into 3 days as before. The day before, at first, the price went down and rebounded back up. As for yesterday, the price hesitated to go up. Decided to be sideways. Therefore, we try to find the trend of yesterday and the day before. Take it as a reference point, which in this place, we look at the high side first. Yesterday and yesterday, the price tried to go up but couldn't go up. Therefore, this area is decided to be an important trend, may have an effect, according to today's price movement. And when it's been 15 minutes, 9:45 a.m., we got 1 red diamond. This diamond is set to range as before and check to see if it's big enough. After checking through the gain, we change the time frame to 5 minutes. As before, from 1 red diamond, now it is turned into 3 bars. At this point, there is an important resistance from the 1 5-minute time frame that we set at the beginning. And we will set the time to enter the trade at 11.3. Don't forget, because in the previous day, there was an uptrend in the milk market, and yesterday it was not decided. Therefore, in the overall picture, it is still up. We will enter the trade on the buy side only. Next, we will wait for the breakout to occur in the week. In this example, just wait 10 minutes. The price has risen to the first bar. We will not buy yet. We will buy when the next bar is green, which is the second bar here. The second tank is very important because the price is important. Therefore, the price has a chance to break out and go up for a long time. We will buy according to the system when the second tank is over. I bought it as before. Set the stop loss at the top range, which is this zone. After we get the stop loss, we will set the take profit to have at least 2 to 1. At this point, it will be like this. After that, we wait for the price to go up to TP. This example has an interesting point. The price does not go up immediately, but the pullback returns to the important trend. Now the trend is doing the job as a trend, and the price goes up to our TP. Then we sell it for profit as before. The third example will be the fall. We're at the time frame of 15 minutes. Divide the day into 3 days, as before yesterday and today, when the market opened. Looking at the trend, we found that it was a downward trend, and most importantly, there is one trend. This point is the trend of both the day before and yesterday. Therefore, it is an important trend to keep an eye on. After 15 minutes, the market opened. There was a lot of speculation. There was a fight between buyers and sellers. The price is only a long skyline, both above and below. We do the same step and set the range in the first 15 minutes. Don't forget, we have to check the gain first so that it passes the ATR gain. After passing, we will change the time frame to a smaller time frame. After changing, the appearance will be like this. Don't forget, we have an important trend, not close, not far. After that, we set the time to enter the trade until 11:03 a.m. As usual. A little more. Because it is a market, we will trade only on the sell side. We will wait for the price to break out in the trend and then enter the trade, which, just wait a minute. Within 5 minutes, the price will break out. It is the first bar. We will open a short or trade on the sell side. When the two red bars are connected, the second bar is also red. Therefore, through the gain, and most importantly, it also reflects the trend. Therefore, we can open the shot comfortably at this position. After opening, we set the stop loss at the lower range or opening range low, which is a little bit far in this place, but for safety, we have to set it according to the system. Finally, we will set take profit at least 2 to 1, which in this place, it will be removed. Once we get take profit, we will wait for the price to go down until it reaches take profit. This example has a little hesitation to pull back, but in the end, it goes down for a long time and gets profit as well. The last example for this clip is a down market in the 1-5 minute time frame. Divide the day to see the trend first. It is clear that it is a down market from the day before until yesterday. After we get the trend, we wait for the market to fight before the first 15 minutes, 9.45. We mark the position to get our range. After that, we will check the gain that it is enough for trading today. After checking, we will change the time frame to 5 minutes. From a large red bar, after changing, it becomes a 3 bars bar. We set the time to enter the trade at 11.3 as before. After that, we will wait for the price to break out in the week, which in this case, the price breaks out immediately, but it's not as intense as the previous example. It's okay. Our system, number 1, at the breakout, we will wait to open the shot. When it is a red diamond, 2 diamonds are stuck together. The second diamond is really stuck together, so we can find the time to open the shot, which is around here. Our stop loss, if it is the same system, will have to open the bottom of the range. But because it is close to the point where we open the shot too much, therefore we will move our stop loss to be farther than before. In this place, we will use the high of the second bar, which is this bar that we open the shot. When we get the stop loss, we will prepare to take profit. Take profit as before, at least 2 to 1. In this place, because of stop loss, it's short. Take profit is not far away. From the example that I see with my eyes, it should be RR 3 to 1. After everything is done, we wait for the price to go down to TP. This example has already made a profit at 3 to 1, but if friends set it further, there is also a chance to make a profit. In conclusion, opening range breakout is a formula for using one trade when the market opens. In the first 15 minutes, we set the range to enter the trade, but not yet trade. Wait a while for the price to calm down. Once the price is calm, we will enter the trade back breakout according to the trend of the past day. For the next clip, I will take you to see a pullback trade and a reverse trade. Don't miss it. Stay tuned to our YouTube channel for today. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. Have you ever looked at your chart and felt like it's a tangled mess of support and resistance lines? And what's the result? You still get stopped out, over and over again. Forget all that. Stop drawing random lines. In today's video, we're going to completely blow up those outdated textbook theories. Buckle up, because I'm giving you a razor-sharp weapon. The secret to identifying true supply and demand zones for high probability setups. Everything I share today comes from real trading experience, meaning you might hear some concepts that completely go against the retail crowd. Ready to level up? Let's go! Part 1. The core concept, bulls versus bears. Let's clear up the definitions first. Supply simply means sellers are pushing into the market. Therefore, a supply zone is a price area in the past where sellers took absolute control, often represented by previous peaks or broken valleys. Conversely, demand represents buyers stepping in. A demand zone is an area where buyers previously dominated, which could be previous valleys or broken peaks. A lot of people call these support and resistance or key levels. But honestly, those textbook terms don't reflect the true nature of the market, the brutal battle between buyers and sellers. It's much easier to visualize if we call the demand zone the bull zone and the supply zone the bear zone. The name doesn't matter. What matters is understanding the dynamic of the money flowing in. Part 2. The retail trap, drawing meaningless lines. Here is the biggest mistake beginners make. Drawing horizontal lines across as many peaks and valleys as possible. Because there are no strict rules, you'll constantly second guess whether you should connect these two bottoms or those two bottoms. If you draw every possible line, your chart will look incredibly messy, making it impossible to actually trade. In fact, here is the harsh truth. If you close your eyes and place a random horizontal line anywhere on your chart, it will inevitably cross some random peaks and valleys, looking like a valid support or resistance level. Relying on this flawed method is a massive mistake. Part 3. The pro rules for mapping zones. So, how do we draw zones correctly? You need to follow these 3 core rules. Rule 1. Focus on current price. We only pay attention to the zones closest to the current price. Our goal is to find good entry points to trade, not to be chart artists. If the price hasn't even reacted near the closest zones, drawing distant zones is completely useless. Rule 2. Zones are relative areas. A zone is not a single fixed line, it's an area. You can draw it using wicks, small candle bodies, or 2 close reaction points. But the best way to start is by taking the highest or lowest extreme point of a peak or valley to mark your zone. For visual clarity, color your bear zones, supply red, and bull zones, demand green. Rule 3. Momentum is king. This is crucial. The strength of a zone depends on the momentum, the explosive move that originated from it. Look for areas where the price dropped massively or pushed up with extreme speed. Those fast, aggressive moves indicate a very strong zone. Part 4. Real trade case study, XAU USD. Let's look at a real multi-time frame case study on the XAU USD pair from this past week. Step 1. The 1-hour chart, H1. We clearly see a massive bullish wave that broke through previous resistance zones. This momentum confirms the buyers are in control. We map out our potential demand zone here. Step 2. The 1-5-minute chart, M15. We zoom into M15 to refine this zone so it perfectly encapsulates the accumulation candles. The bias is extremely clear. H1 broke out upwards, and M15 is maintaining a bullish structure. Our only plan is to look for buy setups in this zone. Step 3. The 5-minute chart. M5. The price pulls back into our demand zone, but remember, no blind entries. We drop to M5 to watch the price action closely. After hitting the zone, the price creates a small bounce and then forms a consolidation phase. Suddenly, a strong candle definitively breaks out of this consolidation. Step 4. The entry. That breakout is our perfect entry signal. We execute a buy right there. And what happened next? The price rallied aggressively, hitting our take profit target perfectly. A highly successful textbook trade using supply and demand. Trading supply and demand, or bull and bear zones, is all about understanding market imbalance. If you found this video helpful, smash that like button and let me know in the comments what topic you want me to cover next. Therefore, you must know how to identify the correct and strong supply and demand zones. To determine which zone is strong and which is weak, we will primarily consider 3 criteria. First, it is important to see how much time the price spends in a zone. Here, you have a supply zone on the top and a demand zone below. The market moves upward, forming a strong bullish candle. And after forming a small indecision candle at the top, it reverses from here with red bearish candles, which creates a supply zone on the chart. Here, the market has come down sharply by forming just one candle. Hence, we will call this supply zone a strong supply zone because the sellers have completely dominated the buyers here, and they are very interested in selling the price from this zone. Similarly, the price comes down with strong bearish candles but reverses suddenly from the lower level. It happens that the price has reversed here after spending very little time. Hence, we will call it a strong demand zone. In another example, the price spends more time in the supply zone than before and then comes down. This means that there has been a little fight between buyers and sellers, in which the price has come down due to the sellers dominating. Hence, we will call it a standard supply zone. Similarly, while going down, the price stays in the demand zone for some time and then reverses and comes up again. Therefore, this is also a standard demand zone. In the third example, the price spends a lot of time moving up and down in the supply zone by forming small candles and later comes down. This means that due to the equal number of buyers and sellers, the price remains balanced for a long time. And finally, due to a slight increase in selling pressure, the price goes down. Therefore, we call it a weak supply zone. Similarly, the price spends a lot of time in the demand zone, due to which this is also a weak demand zone. Let us now see the second criteria. Here, while the price reverses from the supply and demand zone, it forms strong momentum candles. This means that in both these zones, the sellers and buyers are in a very strong position, and hence such momentum candles are formed on the chart. That is why we consider such supply and demand zone as strong zone. But here in the second example, while the price reverses from the supply and demand zone, a normal size candle is formed. It forms and moves forward at a slightly slower speed. Hence, we will see it as a standard supply and demand zone. At the end, the price falls below the supply zone and forms small red candles, along with some green candles in between, which means that sellers are not very interested in selling from here, due to which the price comes down slowly. Hence, we call such a supply zone a weak supply zone. Similarly, when the price moves upwards from the demand zone, so it comes up by forming small candles, due to which the price takes a lot of time to come up. Hence, we can call it a weak demand zone. If the price reverses after retesting any supply and demand zone for the first time, then you can enter a fresh trade here in the direction of reversal. However, if the price retests the supply or demand zone more than once and tries to come back to the same zone again and again, then it signals a weak zone. At such times, you should always avoid entering a trade in the direction of reversal. You can also use all these criteria to know which zone is weak and which is strong regarding the support and resistance zone. Let us now know how to enter a trade in the demand zone. This is the 5-minute time frame chart of Bank Nifty dated March 5. Here, as soon as the market opens, the price forms a big red candle. This kind of price action forms on the chart. Here the market is consolidating in a small range. Till now, the price has not given a successful breakout on any side. Here, the price tries to break this zone, but no candle closes above this zone. Hence, we will not enter the trade here. After some time, the price once again moves up, taking support from below, and a small bullish candle is formed above this zone, but does not break the wick high of the previous red candle. After some time, when the price again rises, then the chart but a 3 inside up candlestick pattern is formed, which is again a bullish candlestick pattern. Here we have 2 bullish signals, higher low and 3 inside up candlestick pattern. However, the price has not yet broken its previous high. Therefore, we will not enter the trade until a confirmation candle is formed on the chart. As soon as the next candle opens, sellers push the price down, but buyers enter the market, due to which a hammer candle is formed on the chart. Now, we can enter the trade on the closing of this candle, in which we will have to place our stop loss below this swing low. After some time, the price moves upwards and hits our target with big bullish Maru Boju candles. Here, if we had entered a long trade on this green bullish candle with impatience, our stop loss would have been hit, due to which we would have exited the trade. If you want to become a successful trader in Forex market, then you will have to wait for the market to reach your correct trade entry point, because unless you make your psychology strong in the market, you cannot survive in the market for long. If you liked our video, then please like the video and subscribe to the channel. Thank you. Most traders think RSI is just an overbought and oversold indicator. In reality, that's only a small part of what RSI can actually do. This indicator is called the Relative Strength Index, or RSI. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. RSI is an indicator that beginners often use. However, experienced traders or traders who have been in the market for a while often overlook it because they believe it generates too many false signals. I used to be one of those traders. I switched to using other momentum indicators, such as stochastic or MACD. Today, I'd like to bring everyone back to RSI and show you 7 different ways to use it. I hope beginners will enjoy it, and I hope experienced traders won't get bored before we finish. Let's go through all 7 techniques together. Before we begin, let me quickly review RSI in just 2 slides. RSI is a momentum indicator that measures the strength of price movement. The indicator ranges from 0, which represents very weak momentum, to 100, which represents very strong momentum. When you open a chart, you'll see the RSI at the bottom. I've highlighted it in yellow. There is a horizontal line that separates weak momentum from strong momentum. That line is the 50 level. Now, let's divide the chart into 2 sides. On the left side, you'll notice that the RSI stays below 50 most of the time. If you look at the price, you'll see that the market is in a downtrend. In other words, the market is weak. On the right side, you'll notice that the RSI stays above 50 most of the time. If you look at the price, you'll see that the market is in an uptrend. In other words, the market is strong. Now let's add 2 more levels. The upper line is RSI 70. The lower line is RSI 30. The area above 70 is called the overbought zone, or OB. The area below 30 is called the oversold zone, or OS. When the RSI moves above 70, it tells us that the market has become too strong. There has been too much buying. The price has become expensive, so traders may start taking profits. On the other hand, when the RSI falls below 30, it tells us that the market has become too weak. The price has fallen too much and has become cheap. When the RSI enters the oversold zone, like in this example, it tells us that there has already been excessive selling. The price has become cheap. When the price becomes cheap, buyers may step in. As a result, the market may reverse from a downtrend into an uptrend. On the other hand, when the RSI enters the overbought zone, like in this example, it tells us that buyers have pushed the price too high. The price has become expensive. When the price becomes expensive, traders may start taking profits. That's the basic foundation of how to use RSI. From this point on, I'll show you 7 different RSI techniques. Let's begin with the first technique. Technique Hashone is the most common one that everyone is familiar with, overbought and oversold. The overbought and oversold zones simply refer to periods when the RSI is either too high or too low. For example, in this area, the RSI falls below 30. This means the market has become oversold. As a result, the price has a chance to reverse from a downtrend into an uptrend. This is where we look for a buying opportunity. On the other hand, when the RSI continues rising until it reaches the overbought zone, like in this example, it tells us that the price has become very expensive. There is a chance that traders will start taking profits. Therefore, when the RSI reaches the overbought zone, we can look for a selling opportunity. If we buy here and sell here, we can make a decent profit. For me, however, I don't buy or sell as soon as the RSI enters one of these zones. I prefer to wait. I wait until the RSI comes back out of the zone. Take a look at the highlighted area. This is the oversold zone. At first, the RSI keeps falling until it enters the oversold zone. At this point, I still don't buy. The reason is simple. The RSI, or momentum, is still moving downward. If momentum is still falling, the price is likely to continue falling as well. So we wait. We wait until the RSI climbs back out of the oversold zone. Once the RSI moves back above 30, it tells us that the market is no longer as weak as before. Momentum is beginning to strengthen. At that point, we can enter a buy trade. The price then has a chance to continue moving higher. The same idea applies to the overbought zone. When the RSI enters the overbought zone, we don't open a short position immediately. We wait until the RSI drops back out of the overbought zone first. Once it falls below 70, it tells us that momentum is no longer as strong as before. The market is beginning to weaken. At that point, we can open a short position or close our long position. The price then has a chance to continue moving lower. Next is technique #2, which is regular divergence. There are actually two types of divergence: regular divergence and hidden divergence. This technique focuses on regular divergence. Regular divergence occurs when the price moves in the opposite direction of momentum. It signals that the market has a chance to reverse. There are two patterns. The first pattern is when the price moves higher while the momentum, or RSI, moves lower. In this case, momentum leads the price. This suggests that the price is likely to follow the momentum and move lower later. This is called bearish divergence. The second pattern is the opposite. The price moves lower while the momentum moves higher. Again, momentum leads the price. Once the momentum turns higher, the price has a chance to reverse from a downtrend into an uptrend. This is called bullish divergence. Now let's look at a real example. In this example, you'll see that the price keeps moving lower. As the price continues to fall, we look for a point where the RSI moves in the opposite direction. It's right here. Notice that the price makes a low, then pulls back, and later makes a new lower low. Now look at the RSI. At first, the RSI is lower, but when the price makes a new low, the RSI is actually higher than before. The price is moving down while the RSI is moving up. That completes the conditions for a bullish divergence. However, I'd like to add one more condition. For me, the first RSI low should be inside the oversold zone. This tells us that the market has already experienced heavy selling and is very weak. Then, as the RSI rises, it should be strong enough to break back above the oversold zone. This tells us that momentum is recovering. Only then do I consider taking the trade. In this case, momentum leads the price. The RSI turns higher first, and after a while, the price follows. This is what we call a bullish divergence. Even when we get a reversal signal, we still don't buy immediately. We need price action for confirmation. For example, we can draw a trend line. As long as the market is still in a downtrend, we wait. Once the price breaks above the trend line, it tells us that the downtrend may be reversing into an uptrend. At that point, we can prepare to buy. Another confirmation is to wait for the price to break the most recent high. Once the price makes a new high, we can enter a buy trade. In this example, the price breaks the trend line and also makes a new high. We can enter the trade at the close of that candle. After that, the price has the opportunity to continue moving higher. Now, let's look at another example. This time, it's the opposite. At first, the price keeps moving higher. As the price rises, we look for a point where the RSI moves lower. Right here, the price makes a high, pulls back, and then creates a higher high. Now look at the RSI at the same points. The RSI is weaker than before. Previously, momentum was stronger. Now it has weakened. The price is moving higher while the RSI is moving lower. My rule is the same. The first RSI high should be inside the overbought zone. Then, as the RSI weakens, it should move back below the overbought zone. This tells us that momentum is weakening. Once this pattern is complete, we can prepare to open a short position. This is called a bearish divergence. Just like before, we don't open the trade immediately. We wait for price action confirmation. We can draw a trend line. Once the price breaks below the trend line, it has a chance to continue moving lower. Another confirmation is to wait for the price to make a new low. Once the price breaks below the previous low, we can open a short position. If you look at the chart pattern, you'll notice that it looks very similar to a double top. When the price breaks below the neckline, we can also open a short position. In this example, we have multiple confirmations. We can comfortably enter the short trade. After that, the price has the opportunity to continue moving lower. Now let's move on to technique #3, which is hidden divergence. Just like regular divergence, the price and momentum move in opposite directions. The difference is that hidden divergence is a continuation signal, not a reversal signal. Let's look at an example. The market is in an uptrend. Focus on this point. This is a low. Notice that this low is higher than the previous one. In other words, the price makes a higher low. Whenever the price makes a higher low, we expect the uptrend to continue. Now look at the momentum. The RSI doesn't make a higher low. Instead, it makes a lower low. The RSI is weaker than before, but the price is performing better. That's the idea behind hidden divergence. Even on a day when momentum is weaker, the price can still make a higher low. So imagine what could happen when momentum becomes strong again. The price has an even greater chance of continuing higher. And that's exactly what happens. The price continues moving up. This is called hidden bullish divergence, which signals trend continuation. Now let's look at the opposite example. The market is in a downtrend. Mark these 2 points. The price makes a lower high. Whenever the price makes a lower high, we expect the downtrend to continue. Now look at the RSI. It seems a little contradictory because the RSI is actually higher than before. Momentum is stronger than before, but the price performs worse. This is how I like to remember it. Even on a day when momentum is stronger, the price still performs poorly. So what will happen when momentum becomes weak again? The price has an even greater chance of continuing lower. And that's exactly what happens. As the RSI weakens again, the price continues moving lower. This is called hidden bearish divergence. I've already explained these first 3 techniques in detail in my previous RSI series. The first video covers the basic RSI. The second video explains regular divergence. The third video focuses on hidden divergence. If you'd like a more detailed explanation, you can always go back and watch those 3 videos. Now let's move on to techniques 4 through 7. These are methods of using RSI that you may not have seen before. Let's take a look at them. Technique #4 is what I call pullback to 50. The idea is simple. Instead of focusing on the overbought and oversold zones, we focus on the 50 level. First, let's highlight the RSI 50 line. This line is the key to the entire strategy. Here's how it works. In this example, the market is in an uptrend. If you look at the RSI, you'll notice that it stays above 50 for most of the trend. As the trend continues, the price occasionally makes a small pullback. Whenever that happens, the RSI pulls back toward the 50 line. Notice how many times the RSI touches the 50 line but never breaks below it. It touches the line, then it bounces. It touches it again, then it bounces again. We use these pullbacks to look for buying opportunities. When the RSI pulls back to 50 but doesn't break below it, it tells us that the market is still strong. The bullish momentum is still there. The price has a good chance of continuing higher. Let's look at an example. The market is in an uptrend. As the price continues moving higher, the RSI stays above the 50 level. Eventually, the price begins to pull back. At the same time, the RSI also pulls back toward 50. Notice that the RSI touches the 50 level but never closes below it. This tells us that the market is still strong. The uptrend is still intact. At this point, we look for a buying opportunity. However, we don't enter the trade immediately. Just like the previous techniques, we still wait for price action confirmation. For example, we can wait for a bullish candlestick pattern, or we can wait for the price to break above the previous high. Once the confirmation appears, we can enter a buy trade. After that, the price continues moving higher. Now let's look at a downtrend. The concept is exactly the opposite. As the market moves lower, the RSI stays below the 50 level. When the price makes a pullback, the RSI also rallies toward 50. Again, notice that the RSI touches the 50 level but never closes above it. This tells us that bearish momentum is still strong. The downtrend is still intact. At this point, we look for a selling opportunity. Once again, we wait for price action confirmation. We can wait for a bearish candlestick pattern, or we can wait for the price to break below the previous low. Once we get confirmation, we can enter a short position. After that, the price continues moving lower. The key idea behind this technique is very simple. Instead of buying when the RSI reaches the oversold zone or selling when it reaches the overbought zone, we trade in the direction of the trend. We simply wait for the RSI to pull back to the 50 level. As long as the RSI holds above 50 in an uptrend or below 50 in a downtrend, the trend still has a good chance of continuing. This technique works especially well in strong trending markets. Now let's move on to technique hash 5. Which is RSI trend line. Most traders draw trend lines directly on the price chart. However, you can also draw trend lines on the RSI. In many cases, the RSI trend line breaks before the price trend line. This gives us an earlier signal that momentum is changing. Let's look at an example. The market is in an uptrend. As the trend continues, the RSI forms a series of higher lows. We can connect these lows to draw a trend line on the RSI. As long as the RSI remains above the trend line, momentum is still strong. Eventually, the RSI breaks below the trend line. This tells us that bullish momentum is beginning to weaken. However, we still don't enter a trade immediately. We wait for confirmation from the price. For example, we can wait for the price to break below its own trend line, or we can wait for the price to break below the previous low. Once we get confirmation, we can prepare to open a short position. Now let's look at the opposite example. The market is in a downtrend. This time, we connect the lower highs on the RSI to form a trend line. As long as the RSI stays below the trend line, bearish momentum remains strong. Eventually, the RSI breaks above the trend line. This tells us that bearish momentum is weakening. Again, we wait for confirmation from the price. We can wait for the price to break above its trend line, or we can wait for the price to break above the previous high. Once the confirmation appears, we can prepare to open a buy trade. The important point is that the RSI trend line often breaks before the price trend line. Because of that, it can give us an earlier warning that momentum is changing. Of course, we should never rely on the RSI trend line alone. We should always combine it with price action before making a trading decision. Now let's move on to technique hash 6, which I call trend line break. The trend line here is not drawn on the price chart. Instead, it's drawn on the RSI. Before we begin, I'd like to point out that this technique is mainly used as an exit strategy. It helps us determine when to exit a trade. Let's start with an uptrend. Suppose you've already entered a buy trade. Now you're looking for the right time to take profits. The first step is to draw a trend line on the RSI. At first, the RSI is relatively weak. Over time, it becomes stronger and continues making higher lows. As long as the RSI respects the trend line, bullish momentum remains intact. Eventually, the RSI breaks below the trend line. This tells us that the momentum that was previously strong is now beginning to weaken. If you look at the price chart, you'll notice that the price also starts to consolidate. This suggests that the trend may be losing strength. At this point, we can close the trade and take profits. Let's look at another example on the same chart. Suppose we've entered another buy trade after the pullback. Once again, we draw a trend line on the RSI. The pattern is very similar. The RSI continues making higher lows as momentum strengthens. Eventually, the RSI breaks below the trend line. When that happens, we look back at the price. The price is no longer moving higher aggressively. Instead, it begins rising more slowly. This is another signal that momentum is fading. We can use this opportunity to exit the trade. The concept behind this technique is simple. Momentum leads price. When momentum starts weakening, the price often follows shortly afterward. Exiting at this point is an effective way to protect our profits. Now, let's look at a downtrend. Suppose you've already opened a short position and you're looking for an exit. Once again, draw a trend line on the RSI. The RSI continues moving lower as bearish momentum remains strong. Eventually, the RSI breaks above the trend line. This tells us that bearish momentum is beginning to weaken. At this point, we can close the short position. Doing so allows us to lock in a significant portion of the profit. Let's look at one final example. The market has been in a strong downtrend for a long time. Assume we've been holding a short position throughout the trend. We continue monitoring the RSI. It starts in the overbought area and gradually moves lower. Eventually, the RSI breaks above the trend line. This tells us that momentum is becoming stronger again. When momentum begins strengthening, the market has a higher chance of reversing from a downtrend into an uptrend. This is our signal to exit the short position. By closing the trade here, we can protect a large amount of the profit we've already made. Now let's move on to the final technique. The last technique is actually a feature that's already built into the RSI indicator on TradingView. I call it moving average crossover. Let's see how it works. The yellow line you see here is the default RSI 14. The blue line is the moving average of the RSI. Once again, this is not a moving average on the price chart. It's a moving average applied directly to the RSI. The concept is exactly the same as a normal moving average crossover. When the RSI crosses above its moving average, it signals that momentum is becoming stronger. When the RSI crosses below its moving average, it signals that momentum is becoming weaker. Let's look at an example. At first, the RSI stays below the moving average. This tells us that momentum is still weak. After a while, the RSI crosses above the moving average. This is our first signal that momentum is strengthening. However, just like every technique we've discussed, we still don't enter the trade immediately. We wait for price action confirmation. For example, we can wait for the price to break the previous high, or wait for another bullish confirmation pattern. Once the confirmation appears, we can enter a buy trade. After that, the price has the opportunity to continue moving higher. Now let's look at the opposite example. At first, the RSI stays above the moving average. This tells us that momentum is still strong. Eventually, the RSI crosses below the moving average. This tells us that momentum is beginning to weaken. Again, we don't enter a short position immediately. We wait for price action confirmation. For example, we can wait for the price to break the previous low, or wait for another bearish confirmation pattern. Once the confirmation appears, we can open a short position. After that, the price has the opportunity to continue moving lower. As you can see, this technique is very simple. It uses the moving average crossover on the RSI instead of on the price chart. Combined with price action, it can become another useful confirmation tool. Those are the 7 RSI techniques that I wanted to share with you today. You don't have to use all 7 techniques at the same time. Choose the one that best matches your trading style and practice it consistently. The goal is not to find the perfect indicator. The goal is to understand how momentum behaves and use it together with price action to improve your trading decisions. That's all for today's video. I'll see you again in the next video. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. If you've ever marked a fair value gap, waited for price to come back, entered the trade, and then watched price slice straight through your zone and hit your stop loss, this video is for you. The problem is not that FVGs never work. The problem is that most traders treat every FVG like automatic support or resistance without understanding why it formed, what price should do when it returns, and what it means when that FVG fails. In this video, we'll break down the normal FVG, the psychology behind it, the inverse fair value gap, and how to use it in trading. Part 1: Normal Fair Value Gap. A fair value gap, or FVG, is an area of imbalance created when price moves aggressively in one direction. The easiest way to identify it is with 3 candles. In a bullish FVG, candle 2 usually shows strong bullish displacement. If the high of candle 1 does not overlap with the low of candle 3, the space between them becomes the bullish FVG. For a bearish FVG, the idea is reversed. If candle 2 creates strong bearish displacement and the low of candle 1 does not overlap with the high of candle 3, that space becomes the bearish FVG. An FVG is not just a rectangle, it is evidence of displacement. In a bullish FVG, buyers push price higher aggressively. In a bearish FVG, sellers did the same in the opposite direction. Context matters. A bullish FVG formed after a break of a previous swing high is very different from a tiny FVG inside a sideways range. Instead of asking only, "Is there an FVG?" ask, "What did this FVG accomplish? Did it break structure, appear after liquidity was taken, or align with the market direction?" The basic idea is simple. If price creates a bullish FVG and continues higher, we wait for a pullback instead of chasing price. If buyers remain in control, price may react and continue higher. For a bearish FVG, we wait for price to retrace into the gap and look for selling pressure to return. But price does not have to respect every FVG. An FVG is an area of interest, not an automatic entry signal. Observe the reaction when price returns. Part 2. The psychology behind FVG. To understand FVGs properly, think about buyers and sellers, not boxes. When the market is balanced, price trades back and forth. But when one side becomes much more aggressive, price expands quickly. That expansion creates displacement, and the imbalance left behind is what we call an FVG. Imagine buyers create bullish displacement and leave a bullish FVG behind. Later, price retraces into the gap. If buyers are still in control, we expect them to defend it through rejection, bullish displacement, a short-term choke, or BOS. But if sellers push straight through the bullish FVG with strong bearish displacement, the area that represented bullish strength has failed to produce the expected reaction. Traders who bought the FVG may now be trapped. If price later retraces into the same area from below, the market is testing whether that old bullish zone can now act as resistance. The same works in reverse. If a bearish FVG breaks and price closes above it, sellers failed to defend it. If price later pulls back from above and buyers respond, the old bearish FVG may now act as support. Part 3. Inverse Fair Value Gap. This is the foundation of the Inverse Fair Value Gap, or IFVG. A bullish FVG normally acts as potential support. If price decisively breaks through it and closes below it, that bullish FVG has failed. If price later retraces back into the same area and rejects lower, the old bullish FVG can become a bearish IFVG. For a bullish IFVG, reverse the logic. A bearish FVG normally acts as resistance. If price breaks through it and closes above it, the bearish idea has failed. If price later retraces downward into the same area and reacts bullishly, the old bearish FVG can become a bullish IFVG. The sequence. The FVG forms, it fails, price moves through it, retraces back, and then we look for a reaction in the opposite direction. Do not confuse a small wick with a meaningful break. A decisive close and clear displacement gives stronger information. Not every failed FVG becomes a high-quality IFVG. The cleanest setups usually align with a liquidity sweep, choke, BOS, or a break of an important swing high or swing low. Part 4. How to trade an inverse FVG. Let's build a bearish example. The market is trending upward and creates a bullish FVG during strong displacement. Later, price pulls back into that gap. Normally, we would expect buyers to defend it, but instead sellers push through the zone and close below it. If that bearish displacement also breaks a recent swing low, the failure becomes more meaningful. Now price is below the old bullish FVG. Instead of chasing the move, we wait for a retracement. If price comes back into the failed FVG from below, the area may now act as a bearish IFVG. At that point, we watch for confirmation. On a lower time frame, that might be a liquidity sweep, bearish displacement, choke, or BOS. The IFVG gives us the area. Price action gives us the timing. For a bullish setup, reverse the process. A bearish FVG forms, but buyers break through it and close above. If bullish displacement also breaks an important swing high, control may be shifting. We wait for price to pull back into the failed bearish FVG. If it holds as support and bullish confirmation appears, we can consider a long setup. Your stop loss should sit where the trade idea is invalidated, not at a random number of pips. Your take profit should use logical targets such as the next swing high, swing low, liquidity pool, or opposing structure. Then calculate the reward-risk ratio. If the target does not offer enough reward, skip the trade. Part 5. Common FVG mistakes. First, don't trade every FVG. If you mark every small gap, your chart becomes full of rectangles. Focus on meaningful displacement and location. Second, don't enter on the first touch without confirmation. A limit entry model can work if tested, but many traders simply assume price must react. Price action confirmation can help filter weak setups. The third mistake is ignoring market structure. A small bullish FVG inside a strong bearish trend does not automatically mean you should buy. Ask whether it aligns with structure, liquidity, and higher time frame context. The fourth mistake is ignoring failure. If a bullish FVG is decisively broken, do not force a bullish bias. That failure may be giving you a bearish IFVG opportunity. The fifth mistake is poor risk management. No FVG, IFVG, BOS, choke, or smart money concept setup has a 100% win rate. Losses are inevitable. Control risk, use a logical stop loss, and make sure the reward-risk ratio supports the strategy. Part 6. Simple FVG Framework. Here is a simple process. First, determine the higher time frame context. Second, look for meaningful displacement. Third, mark the FVG. Fourth, watch how price reacts when it returns. If the FVG holds, the original idea may remain valid. If it fails with strong displacement, wait for price to move through the zone and retrace back. If the failed FVG now acts in the opposite direction, you may have an IFVG. Then wait for confirmation such as choke, BOS, a liquidity sweep, or strong price action. Define your invalidation. Place your stop loss logically, identify the next meaningful target, and check the reward-risk ratio before entering. If you found this video useful, subscribe to robergoldtrader for more practical Forex trading concepts, and I'll see you in the next video. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. Scalping isn't about taking more trades, it's about taking the right ones. If you're still losing money, this video will show you why. Let's meet. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. Scalping is a short-term trade that is expected to make a profit from the fact that the price changes rapidly. Therefore, the time frame that we will use will be from seconds to minutes. Most of the time frames that I choose to use will be 1-minute time frames and 5-minute time frames. Scalping will focus on speed, accuracy, and most importantly, risk control or set stop loss. The example will be like this. The graph is the base market before the first period. You will see that the graph does lower high all the way. When it reaches a point, the price goes back. The point that goes back, we will look for the market structure shift, or the price has gone up the latest. When the price changes, we can use price action to help enter the trade. When the price goes up for a while, we may have sold out. We look for a new entry point, a short trade. This kind of trade is suitable for a market that is competitive. If you want to buy, you can buy. If you want to sell, you can sell, or what we call high liquidity market. Today, I have a trading technique that I have tested 4 types to share with you. The first type is called previous day false breakout. The first step is to look at the graph. The line that you see now is the day. The distance between one line and another is 1 day. Therefore, I call the left day as yesterday and the right day as today. This technique, we will use the information from yesterday to enter the trade today. The information used yesterday, we will look at the highest price and the lowest price. So I call it previous day high and previous day low. In these two lines, most traders will see it as a positive and negative trend. Therefore, if the price bounces or bounces out, it will be a very good entry point for trading. Next, when we get high and low, we will start to look at the market today. When the price opens, there is a chance that it will go up or go down. In this example, the price goes up. Therefore, I will continue to draw this line. When the price goes up, we have 2 to 3 choices. The first choice, we can trade breakout, or the second way, wait for it to pull back and bounce up. But for this case, we will not trade breakout. We will wait for the price to rise and turn into a false breakout, and we will wait for the price to go back down. At this point, the main part of smart money is the liquidity sweep. The big line pushes the price up and pulls it back down. Therefore, we will wait for the trade to follow the big line. When the big line pulls the price down, we can open the shot and the price will have a chance to go down for a long time. Let's take a look at the example. The first example, you will see the line. Left hand is yesterday, right hand is today. Yesterday, there was a high point around here. It fell out. Friends will not see it, but I will draw a line for you. When we start today, we will keep looking at it. After a while, the price breaks out, has a pullback, and goes up. If you enter this trade and exit quickly, you may get one profit. But for this policy, we will wait for the fall breakout. When the fall breakout occurs, the price will go back. We will not trade breakout and we will not trade pullback. We will wait for the price to go back and become a reversal. After the liquidity sweep, we can open the shot and the price has a chance to go down. Let's take a look at the example. The first example, you will see the line. Left hand is yesterday, right hand is today. Yesterday, there was a high point around here. It fell out. Friends will not see it, but I will draw a line for you. When we start today, we will keep looking at it. After a while, the price breaks out, has a pullback, and goes up. If you enter this trade and exit quickly, you may get one profit. But for this policy, we will wait for the fall breakout. When the fall breakout occurs, the price will go back. We will not trade breakout and we will not trade pullback. We will wait for the price to go back and become a reversal. After the liquidity sweep, we can open the shot and the price has a chance to go down. Friends can close the shot as quickly as possible and get full profits. At this point, you can use other indicators to build a trade. The indicator that I recommend is to look at the volume. When the price breaks out and it goes back, the volume should be very high. This indicates that the market is ready to go down. When we look at the volume is a lot. We can open the shot comfortably. The third example for the first example, as usual, we have yesterday and today. Yesterday, there was a low point at the bottom. When it opens today, the price is still for a while. Finally, the price decides to go down. When it goes down, we wait for a liquidity sweep or a fall breakout. After the sweep, we wait for the price action signal. In this place, it is very clear. You will see a bullish engulfing. Or even better, it is a 3-line strike. The price goes down because of the 3 chains attached, but there are 4 chains that engulf or swallow all the chains before the face. Therefore, the market has risen to the full. You can buy in and the price will go up for a long time. The next example, it's still the same idea as yesterday and today. Yesterday, this point was the low point. Therefore, there will be a previous day low around here. When the price opens today, it seems to go up a little bit, but it went back down, the test that has been accepted many times. Finally, the big line pushed the price to hit the Yoi's stop loss. When the price is pushed down, all the graph liquidity is a fall breakout. Finally, he pushed the price back into the same range. We can buy according to the big picture. The second, third, and fourth strategies will be all pullback trading, but there will be a point of reference and different trading methods. The first method I named first pullback. The principle will be like this. the price goes down first, doing a lower high and a lower low. When it reaches a point where there's a market structure shift, the price goes down and becomes a rise. When the price falls here, we will not enter the trade yet. We will wait for the price to go up and then move back. When it comes back, we will only be interested in coming back for the first time. So I call it the first pullback. When it goes up for the first time, we look at the price action to enter the trade. And when we enter the trade, it seems to be the beginning of the trend. The price has a chance to go up after we buy. Let's look at the example of the first pullback. On the left-hand side, you will see that the price is falling. The price has been making a lower high all the way to the point where the price has fallen the most recently. There is a market structure shift. We don't trade breakout. We will wait for the price to make a first pullback and then come back to the original trend, which has now turned into a trend. When the price goes up again, we will look for a suitable price action to enter the trade. There are many ways to change the time frame. Look at the chart pattern. Look at the skyline graph. After watching and being confident, you can buy. After buying, the price has a chance to go up for a long time. Another example is still the same. The left hand is a long down market. The price made a beautiful lower high until it reached a point where the price went up. At this point, the market structure shifts. We will wait a while. When the pullback price comes back, we will find the time to enter the trade as before. This gold bar is a hammer. I can say that there is a lot of buying power, but due to the fact that the graph is not yet confirmed, we will wait for a while. When the price is small in the first pullback, we see bullish engulfing along with a long trend. Therefore, we can trade in this area or wait for the price to hit this high. After buying, the price rises rapidly. The third example of the first pullback. The market will rise and fall. The left hand is the market to rise, do higher high, and do higher low. We will wait for the price to come back. The latest high, which is in this area. At this point, there is a market structure shift. The price has a chance to go down, but we will wait a while. Wait for the first pullback. There was an increase in the first time, which in this area, it also increased to this area. In this zone, we can find the time to open the shot. After opening the shot, the price will have a chance to go down for a long time. From this example, I'm sure. Wait for the price to hit this area first and then open the shot. But some friends may zoom into this area and open the shot faster than this. The last example for the second factor is the uptrend market, going back down. The price made a higher high and a higher low as before. When the price can't break high, there is a recent low return, it becomes a market structure shift. At this point, we don't trade breakouts. If you trade breakouts, you may get profit. But in this case, we will wait for the first pullback. Wait for the price to come back, adjust. After adjusting to be sure, the price has a chance to go down, back to the bottom. We can open the shot. This pair is bearish and carving. The price has a chance to go down. The third technique is the pullback trade that I like the most. That is VWAP bonds. If you follow this channel from the beginning, you will understand how much I like this indicator. VWAP comes from volume weight average price. Mainly, it is a ratio that takes the amount of buying and selling into account. Similar to EMA, but better, because there is a volume come in and weigh it. The way to look at it starts from these two lines on the left hand, which is a new day, and the right hand is the end of the day. Therefore, from left to right, it is one day. The blue line is the VWAP line. When the day is over, it will reset and start a new calculation at the beginning. Friends may wonder that, why does this line suddenly rise strongly? Actually, it doesn't rise. When it runs out and starts again from the top. The basic view of VWAP, we will look at it like this. I would like to divide the graph into two parts. On the left-hand side, the price will be below VWAP mostly. When the price is below VWAP, it is said that it is a down market. But when the price of VWAP is up, now the price is on the top. When the price is on the top, it is said that it is a down market. The VWAP trade method that I like to use will be like this. But for today, I will only pull one indicator. That is, pullback back to VWAP and bounce up. The principle is that we will wait for the price to run away from VWAP first. After that, there will be a return. When the return comes back, the test at VWAP, we will find an easy time to enter the trade. Look ahead for a while, the price will go back to the test at VWAP again. After the test, we will find a new time to enter the trade. And the price action that I use to confirm the easiest is bullish engulfing. When we meet this pair of gold bars, the green one is closed, eating the red gold bar. You can check it out. The left hand is bullish engulfing. We can buy when the bar is over. When the price goes up, we will close the scalping trade and get full profit. The price goes back again. Bullish engulfing occurs again. We can buy, and the price goes up to profit again. The next example, the idea is the same. The price went up in the first period. After that, try to escape from VWAP. Wait for the price to come back to test at VWAP. After the test, look at the price action. Grab this pair. In this case, in addition to bullish engulfing, it's also a free line strike. So when the price is over, we can buy, and the price has a chance to go up for a long time. The next example is the market going up and going down. At first, the price went up first. After that, there was a return to VWAP. At this point, the mouse area that I pointed out, basically, we will wait for the price to test and then go up, right? But in this place, the price is falling. There is no bullish engulfing. Therefore, we let the price fall further. When it falls, we will have to change the perspective. From trading up, now it will become a trading down. And when the price goes back, this area is a test of the resistance. It is a test of VWAP itself. Therefore, we will look for a chart pattern that can be used to confirm entering the trade. And of course, it will be a chart pattern that is bearish engulfing. When we find bearish engulfing, the price has a chance to continue through the game. We can open the shot, and the price also has a chance to continue for a long time. Scalping trade is a fast trade that can go out quickly when the reward-risk ratio reaches the target we want. The last example of VWAP is complete. Left hand is a rising market. There is a rise to test at VWAP. After the test, look for bullish engulfing, immediately found. Considered to pass the gain. After passing the gain, we can buy it. After buying, we sell it on the top, and we wait for the price to rise again. But this time the price rose back down. Therefore, we will not buy this trade, because there is no confirmation that the price will bounce up. When the price goes down, we look at the stock market instead, and the price went back to the test at VWAP. After the test, no more power. Can't go on anymore. Turned into bearish engulfing. We can open the shot, and the price has a chance to go down for a long time. The last advantage for trade scalping that I tested and got good results, that is pullback to fair value gap. Fair value gap. If you were in the smart money concept line, you will know fair value gap very well. But for those of you who are not in the SMC line, I have a short review for you. FVG, or fair value gap, is when the price rises or drops rapidly. There is an empty space of price. In this area, when the price moves too fast, the price you see may not be the price it should be. For example, there is a price shift, or it may be good news or bad news, causing the price to rise due to panic. It looks like this. There are 3 bars. The first bar is still normal. When you find the second bar, the price rises rapidly, creating a fair value gap. At this point, we will measure from the high point of the first candle to the low point of the third candle. And in the middle, it is a fair value gap that the price rises rapidly in the second candle. The price goes down, it's the same. It's a candle that goes down first. After that, there was a severe price drop, which turned into a fair value gap. When we find a fair value gap, we will use this principle. The market will try to adjust itself to bring the price back to the price it should be, which we call this price the price that is done or the price that is correct. Fair value price. Therefore, the way to enter the trade is not difficult. We look for a market that is up first. There is a fair value gap around here, and we know that the price has a chance to come back. Adjust to the price that is done. When the price is adjusted, we can buy and hope that the price will go up for a long time. There are many ways to buy. You can buy it from the first time the price hit or buy it in the middle of FVG. If you are experienced, you may zoom in, change the time frame to be more detailed, find a better time to enter the trade. Let's take a look at the example. This example, you will see that the price is high. When the price goes up, at one point the price rose